More data, more hints of doom is how the gloomier pessimists may view the latest numbers from China. Its official factory PMI fell to 50.2 in October. Anything above 50 is still growth, but that's the lowest reading since mid-2016.
Once again, this is another legacy of the trade tensions, which are clearly having an impact at the margin in terms of the Chinese export profile.
And one of China's major suppliers of parts and equipment is suffering. Japanese industrial output fell 1.1% in September. That's far more than expected, with a series of typhoons and earthquakes also taking their toll. For the moment, the Bank of Japan is leaving its massive stimulus on hold, it announced on Wednesday. So long as trade frictions remain, it may be unlikely to do otherwise.
Those inflation targets are still some considerable distance away, and we also have the prospect of a hike in the consumption tax to further complicate the spending picture in the next 12 months.
Earlier this month, China's central bank announced its fourth move to boost bank liquidity this year. It's also stepping up moves to lower finance costs and pledged more support to private firms.
One wouldn't be surprised if we see bank reserve requirements reduced still further to maintain an additional stimulus in terms of the domestic market. So I think the authorities are doing what is appropriate.
A concerted policy response needed if conditions worsen, as already there are pointers they may do. October's new export orders, an indicator of China's future activity, contracted for a fifth month and at the fastest pace in over a year.